Welcome to Journey of Knowledge. This channel is dedicated to helping you master English for economics, business, and finance. Whether you're a student, professional, or just passionate about economic topics. Subscribe to the channel now to receive the most useful videos early and help you improve. Behind every successful business and economy lies a well-structured system of accounts, the key to financial clarity, informed decisions, and sustainable growth. And now, let's explore the system of accounts, starting with key accounting terms used in this article. Behind every successful accounting process, accounting process, accounting process, business transactions, business transactions, business transactions, financial statements, financial statements, financial statements, source documents, source documents, source documents, general ledger, ledger, general ledger, ledger, general ledger, ledger, account, account, asset accounts, asset accounts, liability accounts, liability accounts, equity accounts, equity accounts, cash account, cash account, accounts receivable, accounts receivable, accounts payable, accounts payable, credit sales, sales on account on credit, credit sales, sales on account on credit, supplies account, supplies account, depreciation, depreciation, equipment, equipment, office supplies, office supplies, store supplies, store supplies, unearned revenue, unearned revenue, revenue recognition principle, revenue recognition principle, equity, stockholders' equity, shareholders' equity, equity, stockholders' equity, shareholders' equity, common stock, dividends, dividends, revenues, revenues, expenses, expenses, sales, sales, commissions earned, commissions earned, professional fees earned, professional fees earned, rent earned, rent earned, interest revenue, interest revenue. The accounting process identifies business transactions and events, analyzes and records their effects, and summarizes and presents information in reports and financial statements. The accounting process provides information in useful reports or financial statements to decision makers.
Source documents identify and describe transactions and events entering the accounting process. They are the sources of accounting information and can be in either hard copy or electronic form. Examples are sales tickets, checks, purchase orders, bills from suppliers, employee earnings records, and bank statements. An account is a record of increases and decreases in a specific asset, liability, equity, revenue, or expense item. The general ledger, or simply ledger, is a record containing all accounts used by a company. The ledger is often in electronic form. While most companies' ledgers contain similar accounts, a company often uses one or more unique accounts because of its type of operations. Accounts are arranged into three general categories, based on the accounting equation, asset equals liability plus equity. Asset accounts. Assets are resources owned or controlled by a company and that have expected future benefits. Most accounting systems include separate accounts for the assets described here. A cash account reflects a company's cash balance. All increases and decreases in cash are recorded in the cash account. It includes money and any medium of exchange that a bank accepts for deposit, coins, checks, money orders, and checking account balances. Accounts receivable are held by a seller and refer to promises of payment from customers to sellers. These transactions are often called credit sales or sales on account, or on credit. Accounts receivable are increased by credit sales and are decreased by customer payments. Supplies account. Supplies are assets until they are used. When they are used up, their costs are reported as expenses. The costs of unused supplies are recorded in a supplies asset account. Supplies are often grouped by purpose, for example, office supplies and store supplies. Office supplies include stationery, paper, toner, and pens. Store supplies include packaging materials, plastic and paper bags, gift boxes and cartons, and cleaning materials. The costs of these unused supplies can be recorded in an office supplies or a store supplies asset account. When supplies are used, their costs are transferred from the asset accounts to expense accounts. Equipment is an asset. When equipment is used and gets worn down, its cost is gradually reported as an expense, called depreciation. Equipment is often grouped by its purpose, for example, office equipment and store equipment. Office equipment includes computers, printers, desks, chairs, and shelves. The cost of items used in stores, like counters, showcases, ladders, and cash registers, is included in the store equipment account. Liabilities accounts payable are verbal or written to make payments in the future that typically result from item purchases. Payables can also arise from purchases of supplies, equipment, and services. Accounting systems keep separate records about each creditor. Unearned revenue refers to a liability that is settled in the future when a company delivers its products or services. When customers pay in advance for products or services, before revenue is earned, the revenue recognition principle requires that the seller consider this payment as unearned revenue.
Equity accounts. The owner's claim on a corporation's assets is called equity, stockholders' equity, or shareholders' equity. Equity is the owner's residual interest in the assets of a business after deducting liabilities. Equity is impacted by 4 types of accounts: common stock, dividends, revenues, and expenses. When an owner invests in a company, in exchange for common stock, the invested amount is recorded in an account titled common stock. Any further owner investments are recorded in this account. When the company pays any cash dividends, it decreases both the company's assets and its total equity. Dividends are not expenses of the business. They are simply the opposite of owner investments. A dividends account is used in recording asset distributions to stockholders, owners. Revenues and expenses also impact equity. Examples of revenue accounts are sales, commissions earned, professional fees earned, rent earned, and interest revenue. Revenues increase equity and result from products and services provided to customers. Expenses decrease equity and result from assets and services used in a company's operations. What is the purpose of the accounting process? The accounting process identifies business transactions and events, analyzes and records their effects, and summarizes and presents information in reports and financial statements. 2. What are source documents in accounting? Source documents identify and describe transactions and events entering the accounting process. They can be in hard copy or electronic form, such as sales tickets, checks, purchase orders, and bank statements. 3. What is the general ledger? The general ledger, or simply ledger, is a record containing all accounts used by a company. It is often in electronic form and helps track financial transactions. 4. How are accounts categorized in the accounting system? Accounts are categorized into 3 general types based on the accounting equation: asset accounts, liability accounts, and equity accounts. 5. What is accounts receivable? Accounts receivable are amounts owed to a seller by customers for credit sales. They are increased by credit sales and decreased by customer payments. 6. What happens when supplies are used in a business? Supplies are initially recorded as assets. When they are used, their costs are transferred from the asset accounts to expense accounts. 7. What is unearned revenue, and how is it recorded? Unearned revenue is a liability that occurs when a company receives payment in advance for goods or services. It is recorded as a liability until the company delivers the product or service. 8. How do revenues and expenses impact equity? Revenues increase equity as they result from selling products or services. Expenses decrease equity as they represent costs incurred in business operations.